DeepSeek has been popping off lately, and in my experiments, I've actually been really impressed. So I'm gonna go step by step and showcase how I like to use AI for my investing process. Makes it faster, easier, and therefore better, because the more companies I can analyze, the better chance I have of making a great investment. So grab a drink, take a seat, let me show you what I got. What's up, y'all? It's Brian, and this is my live YouTube investing portfolio series where I invest $100 every week. This is the 8th week of doing this. I've got $1,000 invested in the portfolio. At first, I didn't have my account set up right, and it was pulling extra money in. So an extra $200 got spread out amongst the investments. So that is what explains the disparity there. So quick update on the portfolio. We are up $200, which is nice. HIMS being our best investment so far, it is up 137.85%, which is really good. Crocs, I doubled down on Crocs last week because my investment of choice was not supported in M1 Finance, sadly. So Crocs got doubled down. And then Zeta is doing really well. That one is an investment where they have a short report out on them. Basically, a company is saying Zeta is fraudulent for reasons X, Y, and Z. I did an analysis of that report and found that I think the report is BS. So I think Zeta got pushed down. So that is the investment in Zeta. Those are my three that are doing great. The other ones are down slightly to pretty much flat. We have Simply Good Foods down 2.5%, DocuSign down 6.5%. The investment for this week, which I will blur out, is down 0.8%. So it's basically flat. And then C&Q down 1.8 and Google down 5.5. For now, we're looking pretty good. I'm hoping some of those lower investments will start to creep up over time. Like I said, this is only the 8th week, and these are holdings that I intend to hold for a long time for the most part. The only exception to that might be Zeta, since this is one that I invested in because of the short report. So whenever the short report gets situated and settled, whenever that arc comes to a conclusion, I may pull out of Zeta if it returns back to its previous share price. So enough with the update. Let's get on to this week's investment. One of my favorite ways to utilize AI is in how I funnel down the thousands of companies that are out there to find a company to invest in. So the first step is I like to do trend analysis. It's one of my favorite ways to start. To do that, I go to explodingtopics.com, where they will update their website every few months for the trending topics. And these are long-term trends. These are not just short-term like, oh, Super Bowl search spiked during the Super Bowl. These are things that have been trending up for many months. So I find this website to be very reliable in terms of trending topics. Now they give me 100 different trending topics here. It's way too much for me to go through and analyze myself, or I could, but it would take me a lot of time. So this is where I input the list into DeepSeek. So here is my request for DeepSeek. Below is a list of the top 100 trending topics for the US in January of 2025. These are topics that have strong likelihood to continue in the future. These are not just temporary fads. Please analyze the list of industries that are likely to experience growth in the future. Please keep an investing context in mind for the analysis. So that's the mission I gave DeepSeek. I pasted the whole list of 100 companies, and it gave me a great breakdown of these trending topics. It's got AI, consumer electronics, and wearables. It gives me the individual item from the list and the growth that it experienced, as well as some investing implications at the bottom. Health and wellness, sustainable and green technologies, e-commerce, food and beverage, fashion and lifestyle, gaming and entertainment, cybersecurity and data management, and the pet industry. So it gave me 10 different topics. So what I'm looking for next is I want it to take it one step further. I want to look at how do some of these different trends synergize together into a single industry? Are there any just really good synergies like that it can come up with? So that's what I asked. Absolutely. It gives me another list. So AI, once again, health and wellness. It's giving me companies, hims and hers at lists, which I've already invested in. And I think I arrived at HIMS through a similar process. So this process has worked for me really well in the past with HIMS. Sustainable technologies, e-commerce, gaming and AI, food and beverage, pet industry, once again, cybersecurity and AI. So this one is one that really jumps out at me, specifically AI in finance. AI is undoubtedly a huge trend. I'm using AI right now to help me with my investing. So I want to leverage AI. I haven't invested in finance yet in this portfolio. So I think I want to get some exposure to financial technology and AI. And one of the things that really jumps out at me here is cybersecurity is a huge trend going forward, with post-quantum cryptography being one of the big items on there. So basically what I want to look for is cybersecurity in financial technology. Now that I have narrowed my focus, I'm going to pivot away from DeepSeek and go to ChatGPT, because ChatGPT has live access to the internet, whereas DeepSeek currently does not. So since my next step is to find a list of publicly traded companies that are currently specializing in financial technology and cybersecurity, I want the most recent information. So I'm going to go to ChatGPT for that reason. But I am looking forward to DeepSeek implementing live internet access one day. So pivoting over to ChatGPT, give me a list of publicly traded companies in fintech that are also specializing in cybersecurity. And it gave me a nice list of 10 different companies. So the next thing I do is I ask it to rank the companies in terms of market cap, because when I'm analyzing a bunch of companies in a new industry that I'm not totally familiar with, I like to default by analyzing the bigger companies first because I perceive them as being a little bit safer. So I'm going to skip out on the super small market cap companies. I have it do its thing. It ranks the companies. There we go. I actually didn't catch it at first, but I did see that sale is not yet public. So I asked it to replace it on the list, and it came up with Checkpoint Software Technologies. So I had it replace sale on the list, redo the market cap, which I'm showing right here. And then I'm taking the top 6 companies and doing a health check. Now that I'm over on ChatGPT, I'm asking, give me a list of 10 publicly traded companies in fintech that also specialize in cybersecurity. Gave me 10 good choices. However, looking at this list, I do want to make a few changes. First of all, CrowdStrike, I'm going to have it replace CrowdStrike from this list. I'm already familiar with CrowdStrike, and it's very highly priced right now. It's definitely not going to be a value company, more geared towards speculative growth. And so I already know it's not going to really fit my criteria, so I'm going to have it remove CrowdStrike. Also going to have it remove Stripe because that one's not publicly traded, and then MasterCard and Visa as well because those are not primarily cybersecurity, and I'm looking more for a lean on cybersecurity companies. So I'm going to ask it to replace Stripe, Visa, MasterCard, and CrowdStrike, and now we have our new list where they put SailPoint in there, which just recently went public, Checkpoint, AKAM, and Trend. So the next step would be to rank this list by market cap. Whenever I'm investing in an industry that I'm not super familiar with, I like to go with the bigger companies just because it's a little bit safer. They're more established. And so, yes, they may not be as likely to have the biggest returns, but when I'm going into a category of companies that I'm targeting for their trend, a rising tide is going to raise all ships. So I think this whole cybersecurity niche, fintech, is going to be rising. So I'm happy to pick up the safer choices in that group. Here's the list ranked by market cap: Palo Alto, Fortinet, Zalaskar, AKAM, and Checkpoint number 5. So the next step is I'm going to narrow down this list of 5 into the most likely to be a strong valuation and financially healthy. So for that, I'm going to go to the stock analysis GPT, which is nice. Not only can you access live information on ChatGPT, they also have a bunch of pre-made specialized GPTs. So I'm going to use the stock analysis version for this next follow-up question. Rank the following companies in terms of financial health. I list the 5 tickers, take into account liquidity, solvency, operating efficiency, and profitability. Use the financial data from the most recent quarterly report. So from this, it ranks these companies: Fortinet, Checkpoint, Palo Alto, AKAM, and Zalaskar. So this is their ranking. In terms of eliminating these companies, the only one that I might eliminate from this list would be Zalaskar because it's currently unprofitable. AKAM has moderate performance and stable margins. It has good liquidity. So AKAM looks relatively safe. Palo Alto has some slight liquidity returns. So I might eliminate Palo Alto, but Checkpoint and Fortinet are both looking really good. So the next step is to get ChatGPT to rank these based on their current valuation. So that's what I ask right here. And the new list is Checkpoint, AKAM, and Fortinet as 1, 2, and 3. So I'm going to go down this list in order and use my discounted future cash flow analysis spreadsheet to see if any of these really jump out at me as like a really good deal right now. First up, I'm looking at Checkpoint, current share price of $222, market cap of $24.5 billion. This is the company. So first things first, I want to go into my discounted future cash flow model and see what kind of intrinsic value am I predicting here. Here's the dashboard. It's summarizing some of the key metrics here. Their past free cash flow margin, that's this graph right here, over the past 5 years has been 47.77%. That is huge. These guys are incredible incredibly profitable, very good at creating free cash flow, which is the main metric that I am worried about. Now, their free cash flow has been dipping. It's been trending down over the last 5 years, so I may take that into account. But over here, their shares outstanding also looks really, really good. Since 2020, they have been consistently buying back shares, reducing their overall share count, which means if I invest in this company, then my shares will not being diluted in value. They're not releasing more and more shares, diluting my shares. They're actually buying shares back. So that is also really great. Now, in terms of the analyst predictions, in terms of their revenue growth, I have already pasted them in right here. The highest analyst predictions are saying 12% growth in 2025, 11%, 12%, 8%, 9%. So solid double-digit growth from the analysts. Now, if that comes to pass, then the analyst high revenue share price, according to free cash flow, would be $301. Now, the current share price is $222. So they're not, even in the highest situation, they're not super undervalued. But on the flip side, in the lowest situation, they're $200 per share. So there's a relatively tight range on the predicted revenue and free cash flow for this company. So in my mind, that makes it a pretty safe bet to lean towards the average analyst predictions, which means I'm looking at a 10% premium roughly. If the share price is intrinsic value $247 per share and it's currently $222, then this company looks pretty good. Now, the next company I want to look at, number 2 on the list, is AKAM. This one is currently $100 per share. In order to get my spreadsheet to update everything, I do need to copy and paste the analyst projections. So it looks like these guys are pretty similar in terms of what the analysts believe their revenue is going to do over the next 5 years. So I'm going to copy that information and paste it into the spreadsheet. So with that copied in, all I have to do is change the ticker and we have a new estimate here. So in this case, this is looking relatively similar, slightly undervalued on the analyst low prediction and 60% upside on the high prediction and a 20% upside on the average analyst. So this is a little bit better. Checkpoint was 10% premium for the average analyst prediction, and this is a 20%. So right off the bat, I'm thinking I'm leaning slightly towards AKAM, but they are less profitable. Let's look a little bit deeper into the free cash flow. So their free cash flow margin has bounced up and down quite a bit. So I feel comfortable going with the average. Their shares outstanding have consistently been decreasing, which means they're buying back shares, not as much as Checkpoint, but they are buying back shares. So I like that a lot. The next thing I might do is see how could I tweak their free cash flow margin either up or down, depending on how they're spending their money. So right here, something I added to my spreadsheet, this automatically compiles their research and development, their capital expenditures, their acquisitions, and their stock compensation in absolute value and in terms of what percentage of their revenue are they spending on these things. So for R&D, AKAM is spending 11% of their revenue. They're spending 15% in 2023 on their capital expenditures and 3%, 24% in 2022 on acquisitions, 17% in 2021. So in my mind, they are spending a lot of money on trying to grow this company, and those expenditures are increasing year over year in terms of absolute value, not necessarily in terms of percentage, but certainly in terms of absolute value for research and development and capital expenditures. So in my mind, I could potentially adjust their free cash flow a little bit in this case. Normally, research and development is counted 100% against free cash flow because it's considered an expense, so it's eliminated out before you calculate the total income. So I'm going to give 25% of the R&D back. I'm going to give 25% of the CapEx back. And in this case, for the acquisitions, normally acquisitions in this calculation, it does not go against free cash flow, but I do think that some percentage of the acquisitions should go against free cash flow. So in this case, 25% of the acquisitions is being subtracted out of the free cash flow. And same with the stock compensation. So these guys are paying 6% to 9% of their revenue in stock compensation. Now, this value doesn't count against their free cash flow, but in my mind, it kind of should, because if their overall share buybacks are in the positive, they have to buy back even more to counteract the stock compensation. So if I go to AKAM and I go to their financials, let's look at an example of this. I go to their cash flow. If I scroll down to the investing cash flow, I see issuance and repurchase of common stock. So they bought back $646 million worth of stock. They issued $61 million. But then when I scroll up here to stock-based compensation, they also paid out $386 million. So whenever those options are all exercised, that $386 million is going to be diluting my shares. The 386 kind of goes against repurchase of common stock. It goes against the $646 million. So I am going to count 50% 100% of that stock purchase against the free cash flow. So if I make those adjustments, then the new average is about 24%. The current average is 24%. After making those adjustments, it really doesn't change anything for AKAM. If I give Checkpoint Software Technologies the same treatment, let's see what their result is for free cash flow. If I give them the same treatment, then they're really not changing much either. They're sitting at about 47%, which is a little bit less than their current average. Now, I would adjust Checkpoint down slightly in terms of their free cash flow margin because they have been trending down over the last 5 years. Their latest free cash flow margin was 40%. So if I reduce this current free cash flow by 7%, let's see how that affects their share price. And I just remembered I need to go back to Checkpoint and repaste in their analyst projections because currently AKAM's in there. Repasting again. So with that in mind, the analyst low projections are now at $169. So if I wanted to see what kind of revenue growth would be required for their current share price to make sense, which is $222 per share, let's bump this to 6%. That's going to be even higher. So they're going to need 7% annualized revenue growth for their current share price to make sense. Whereas with AKAM, they only needed 4% revenue growth for their current share price to make sense. So because of that, I'm leaning towards AKAM. Furthermore, whenever I go to their SEC filings, I can see their list of risk factors. So Checkpoint, I learned after reading through their SEC filings that they are based in Israel, and in their list of disclaimers here, if I can find it, risks related to our operations in Israel. So there is ongoing war in Israel with Gaza. Tensions are high. So I feel like this brings another element of risk to investing in Checkpoint. Now, I think Checkpoint is a really good company, just based on their insane margins, their insane share buybacks. So in the future, if I see their share price come down a little bit, without the analysts bringing down their projections, obviously, if the analysts change their future projections significantly, then that'll also affect the calculation. But if I see their share price dip down and it doesn't look like it should, maybe then it would be worth it for me to invest in this company to take some of that downside risk off the table. That is why I love finding value companies, because if a company is slightly undervalued or moderately undervalued, they have less downside, less room to fall, as opposed to if they're overvalued. Because if a company is overvalued and then they drop down to fairly valued, well, you're still losing money. So in the event of a market downturn, we've been on a hell of a bull run lately. A lot of people are saying that they think a recession is coming or a bear market is coming. If that's true, then investing in value companies gives me an extra element of security investing in this climate. So for this week, I am investing in AKAM. So this is me an hour before uploading the video because there is new information out that I just had to include. Unfortunately, I filmed this video a week ago, and yesterday, AKAM released their fourth quarter guidance for the year and their guidance for 2025. They actually beat their projected earnings for this quarter. However, they reduced their future projected revenue and earnings. And because the markets are forward looking, the stock price plummeted by about 23%. It's now trading about $76, $77 per share. Unfortunately, I bought it at $100, as you know. I wish I would have bought it today because it is even more on sale than it was before, in my opinion. When I enter in their latest revenue projections into my free cash flow analysis spreadsheet, they previously thought they were going to have revenue growth of about 4%. They're now saying about 2.5%. When I put that in, I'm getting a projected fair share price of $86 per share, as opposed to 104, which is what I think I calculated before. So they're still on sale. The low analyst projections put their price at 79, lower than before, but still above the current share price. And the high analyst projections put their fair share price at $154 per share. So in my mind, according to the free cash flow analysis, this company is even more on sale than before. It just got a haircut. I wish I would have bought now. But, unfortunately, I cannot see the future. This kind of thing happens in the world of investing, and you just have to react to new information. That's one reason why I like to stay diversified. This wasn't my whole portfolio. This is 1 out of 8 or 9 companies. So losing 22% on this stock isn't devastating to the YouTube portfolio. All I can do is double down on the new, better price and try to get them next time. And also with Checkpoint, if I see their price drop significantly to where their valuation looks a lot better, then I would definitely consider investing in Checkpoint as well. If you're interested in this type of content, check out the most recent, or I guess the previous video in this series, and I'll see you there. Catch you on the flip side.